Hey everyone, welcome back to Corporate Decoder. Today we're diving into Autonomix Medical's latest proxy statement. And let me tell you, there's a lot going on, including some big decisions that could change how the company looks. Before we get into the spicy details, if you like your corporate news served straight up without the jargon, make sure to subscribe. And hey, while you're at it, join our Discord community linked below for more real-time insights. Autonomix Medical is preparing for its annual meeting of stockholders on October 30th of next year. This is where shareholders get to vote on key company matters. The company is using the notice and access model, meaning they're largely providing information online to save on printing costs, which is pretty standard these days. First up is the election of directors. They're asking shareholders to re-elect all 5 current board members. These are the people steering the ship, so it's always important to see who's being put forward. Next, they want to ratify the appointment of their accounting firm, Forvis Mazars LLP. This is basically a stamp of approval on who's checking their financial books. Now, things get interesting with Proposal 3. Autonomix is asking for permission to do a reverse stock split. This is where they combine existing shares into fewer, more valuable shares. The board wants the flexibility to choose a ratio anywhere from 1:2 all the way up to 1:25. Why would they do this? Well, the filing mentions their stock price is hovering around the 151.17 mark, which is close to the $1 minimum, required to stay listed on the Nasdaq Capital Market. A reverse split could boost that share price and make the stock more attractive to bigger investors who often shy away from low-price stocks. Proposal 4 is about approving an amendment to their 2023 Equity Incentive Plan. Essentially, they want to increase the number of shares available for employee stock options and other equity awards. They're asking for an additional 1.9 million shares, bringing the total to over 2.2 million. This is common practice for companies looking to attract and retain talent, especially in competitive fields like biotech. It ties employee interest directly to the company's stock performance. Proposal 5 is a big one. They entered into a purchase agreement with Lincoln Park Capital Fund for up to $15 million worth of common stock to comply with Nasdaq rules, which don't like companies issuing too many shares cheaply without shareholder approval. They need your okay to sell more than 20% of their outstanding stock under this agreement. This usually means the price of these shares might be lower than the current market price, hence the need for approval. They've already issued over 60,000 shares as commitment shares to Lincoln Park. Let's look at who owns what. As of August 26, 2025, key people like Walter Klemp, the executive chairman, hold about 150,000 shares, which is about 2.6% of the company. Most of the management team and directors hold less than 1% each, but these numbers include shares from convertible notes and warrants that could be exercised soon. Now for the juicy part, executive compensation. For the fiscal year ending March 2025, the Chief Executive Officer and President Brad Hauser had a total compensation of over $1.6 million. This included 5 and average of $259,000 in 2009 and stock awards valued at over $1.1 million. Laurie Bisson, the Executive Vice Chairman, also had a substantial compensation package topping $59,000. In 2000, the Executive Vice Chairman also had a substantial compensation package topping $600,000, a base salary of $300,000, and stock awards valued at over $1.1 million. Laurie Bisson, the Executive Vice Chairman, also had a substantial compensation of $59,000 in 2025. It's worth noting that a big chunk of this compensation for executives like Mr. Hauser and Ms. Bisson comes from stock options. For example, Mr. Hauser received option awards valued at over $1.1 million. These are essentially the right to buy a company's stock at a set price in the future, and their value depends entirely on the company's stock price going up. Looking at outstanding equity awards at the end of March 2025, we see various stock options granted. For instance, Brad Hauser has options for 45,000 shares with an exercise price of $27 vesting over 4 years. Vendy Toth, the Chief Technology Officer, also has options for nearly 9,000 shares at a similar exercise price. Going back to that reverse stock split, they're hoping it will boost the stock price to meet Nasdaq's minimum requirement. But a word of caution, while they believe it might help, there's no guarantee the market price will jump or stay high. Many companies that do reverse splits see their stock price fall afterwards, so it's a bit of a gamble. Regarding the equity plan, the company is asking to increase the total shares authorized for issuance from about 370,000 to nearly 2.3 million. This is a significant increase and shows their reliance on stock-based compensation for employees. They've highlighted features like no repricing of options and limits on director pay to protect shareholder interests, which is good to see. About that Lincoln Park Capital deal. This agreement allows Autonomix to sell stock to Lincoln Park over 24 months to raise up to $15 million. They can make regular purchases of up to 30,000 shares, with potential increases if the stock price is above certain thresholds. They can also make accelerated purchases, basically buying more under specific conditions. The purchase price is generally 97% of the market price, meaning Lincoln Park gets a bit of a discount. The crucial part here is that NASDAQ rule. If the stock price stays low, they can only sell a limited amount of shares to Lincoln Park without shareholder approval. Selling more than 20% of outstanding stock without approval, especially at a discount, can trigger NASDAQ scrutiny. That's why Proposal 5 is so important. For most of these proposals, like ratifying the auditor, approving the equity plan, and the Lincoln Park stock issuance, they need a majority of the votes cast to pass. For the director elections, it's a plurality, meaning whoever gets the most votes wins. The reverse stock split just needs more votes for it than against. So what's my take on Autonomix? They're clearly in a growth phase, using equity to fund operations and attract talent. The proposal for a reverse stock split signals a concern about their listing status, and the Lincoln Park deal provides a potential capital lifeline, but at the cost of dilution if a lot of shares are issued. The executive compensation seems high, but that's common in this industry. The real story here is whether they can navigate these financial and regulatory hurdles to drive future growth. Will the reverse split work? Will the equity dilution hurt existing shareholders? It's a balancing act for management. Alright, that's our deep dive into Autonomix Medical's proxy statement. Let me know your thoughts on these proposals in the comments below. If you found this analysis helpful, give it a thumbs up and subscribe for more. And don't forget to join our Discord community, linked in the description. Thanks for watching. See you next time.